Raising capital for your business. Every entrepreneur knows that adequate financing is vital to the success of a business. Failure to acquire adequate funding often determines whether a business can get off the ground, not to mention whether it can sustain itself into the future. In the startup phase, capital is required as most businesses need operating finance as well as covering personal expenses. A new entrepreneur should aim to cover personal expenses for at least 3 to 6 months so that the business has a chance to become self-sustaining. It's best to consult an accountant and an attorney, both of whom can be very helpful in the quest for financing. They can be especially useful in assisting with the preparation of the business plan, the management and financial blueprint for a new venture. Figuring out exactly how much money will be needed is an integral part of the business plan. Start by asking these questions. 1. Does the business provide a service or a product? At least initially, a product-producing business typically requires more money because it involves high material and equipment costs. 2. Will there be employees? If the owner will be providing most or all of the labor, at least initially, the money required will be less than if the business requires many employees. 3. Is there personal funding available? Lenders or investors may require that the entrepreneur invest and risk his or her own money in the business. The amount contributed, called equity, will generally depend on how much the owner can afford. Startup costs. Figure out an estimate of the startup costs, which are only needed once. Monthly expenses. It's also necessary to estimate the monthly business expenses and add them up. Multiply this monthly total by 3. This represents the amount of money needed for the initial months of operation. Though oversimplified, the following chart is an example of a monthly expenses worksheet. Personal net worth. Create a statement similar to this one. How much of that net worth is available? Once the net worth has been calculated, determine how much of that is available for investment in the new venture. Note that a portion of the net worth, such as equity in a home, may not be liquid, that is, easily converted to cash. Devoting all the net worth to a new business could compromise the family's financial security. The portion of the net worth that is accessible and can be invested without subjecting one's family to excessive financial risk is the available net worth. The amount needed from debt or equity investors. To calculate how much will be needed from debt and equity investors, simply subtract the available net worth from the sum of the startup costs and the 3-month expense total. With a good business plan that includes these calculations of needed costs and available net worth, it will be easier to approach a bank or investor for funding.